A balance sheet is a financial statement that specifies the financial position of a company at a specific point in time. It's like a snapshot that specifies what the company owns and owes. It comprises of mainly three parts: assets, liabilities, equities. Assets are what the company owns, such as properties, plants and equipments, cash, accounts receivable, etc. Liabilities are what the company owes, such as unpaid debts, other debts, loans, accounts payable, etc. And equities are the shareholders, owners in a company after all the liabilities have been subtracted from the assets. A balance sheet is built around the accounting equation assets equal to liabilities plus equities, and this needs to hold true every time. It helps investors and business owners understand how stable and financially healthy the business is at the moment. In essence, we need to make sure that every time a single accounting transaction is entered, it balances the balance sheet. When the transactions are recorded in the financial records of a business, something called double entry accounting or double entry bookkeeping is used. Now, the assets are everything that the business owns and has value and that can help generate income for the business. They are listed on the balance sheet and are usually categorized based on how quickly they can be converted into cash. That is the most liquid to the least liquid. There are generally two kinds of assets: current assets and non-current assets. Now, the current assets are those that are expected to be used or converted into cash within 1 year. Examples are cash, the money the business has on hand or in the bank; accounts receivable, the money the customers owe the business; some inventories, like the products or materials that are ready to be sold; prepaid insurances or expenses, like the payments that are made in advance, like the rent or insurance; marketable securities, like short-term investments that can be sold quickly for cash. Now, non-current assets are those that are expected to be used for more than a year to help the business operate over time. Some examples are PP&E, this is also known as properties, plants and equipments, also called capital assets such as buildings, properties, plants, equipments. These are long-term assets. Long-term investments such as stocks or bonds the company plans to hold for more than a year. Intangible assets or non-physical assets such as patents, copyrights, brand value. Deferred tax assets, the tax savings the company can use in the future. In short, assets are the resources the company owns that supports future growth and economic output. Liabilities are what a business owes to others. They represent obligations, debts, bills, payments the company must settle in the future. Balance sheets, the liabilities show how much of the company's assets are financed by borrowing. Liabilities are listed on the order of their maturity, that is, on the order of when do they need to be paid back. There are two main categories of liabilities: current liabilities and long-term liabilities or non-current liabilities. Now, current liabilities are short-term liabilities that the company must pay within 1 year. These are short-term obligations. Examples are accounts payable, the money owed to the suppliers for the goods or the services received; short-term loans, loans or credit lines due within a year; wages payable, salaries owed to employees; taxes payable, taxes owed to the government; interest payable, interests on loans that haven't been paid yet; current portion of the long-term debt, the part of the long-term loan that's due this year; money received for services that have not been delivered yet, such as subscriptions. Non-current liabilities or long-term liabilities are the obligations the company will pay over a period longer than 1 year. Long-term loans, bank loans or bonds payable over longer period of time, generally more than 1 year. Long-term rental agreements under accounting rule. Deferred tax liabilities, taxes owed in the future due to timing differences. Pension liabilities, money owed to the employees for retirement benefits. In simple terms, liabilities represent who the business owes money to and helps investors understand the company's financial obligations. They're a key part of accounting equation, that is, assets equal to liabilities plus equities. Now, the equity represents the owner's share in the business. It's what's left after subtracting all liabilities from the company's assets. In short, equity is assets minus liabilities. it shows how much value the owners or shareholders truly have in the company. On the balance sheet, equity is also called the owner's equity or the shareholder's equity, depending on the type of the business. There are different types of equity depending on the business structure. For sole proprietorships or partnerships, owner's capital is the money the owner originally invested in the business, and the owner's drawings is the money the owner takes out for personal use. This reduces the equity. And the retained earnings is the profits the business kept instead of distributing. And for corporations, the common stock is the money raised by issuing shares to investors, those are the owners. And the preferred stock is a special class of shares with fixed dividends, often with less risk. An additional paid in capital is the money received from shareholders above the par value of the stock. And the retained earnings is the profits kept in the company instead of being paid out as dividends. And the treasury stock is the shares the company has bought back. This reduces the total equity. And the accumulated other comprehensive income are the gains or losses not included in the net income, like foreign currency adjustments or unrealized gains, losses on investments. Equity is important because it shows how much the company is worth to its owners after paying off all debts. A growing equity over time usually signals a healthy and profitable business. Now we need to learn something about SEC. The Securities and Exchange Commission, SEC, is the United States government agency that regulates public companies. All public companies like Microsoft, Amazon, Tesla, Goldman Sachs are legally required to file financial reports with the SEC. And the key SEC filings that contains the consolidated balance sheets are the 10Q quarterly report, the 10K, the annual report, and the 8K, that's the event report that suggests any CEO changes or acquisitions and mergers, etc. Now, this is the Goldman Sachs website, and I'm going to find the balance sheet. I'm going to scroll down. I'm going to find the investor relations, that's at the bottom. I'm going to go to financial documents. Then I can either go to the annual reports or quarterly earning releases. I choose annual reports. I have so many options. I can select the 2024 annual report and I can download this report. And I'm going to open that and I'm going to hop into the balance sheet section. Now I'm going to show something else. Hopping back again to the financials, I'm going to select Form 10Ks this time because this has the consolidated balance sheet. I'm going to select the first one, Form 2024 10K. And this is the same as this one, the only difference being I already migrated to the page consisting of consolidated balance sheets and the page number is 132. So I can see that we have the assets for both 2024 and 2023. So the total assets for 2024 would be the cumulative sum of everything. Similarly for 2023, so all these values. And the liabilities and shareholders' equities are categorized together because we're going to be benchmarking this value against the total assets, and that should be equal. All these represents liabilities and their sum would be the total liabilities for 2024 and 2023 respectively. Similarly, the shareholders' equity is represented by all these individual values and their total would be the cumulative sum of everything for both 2024 and 2023. Now we're going to be adding both the total liabilities and the total shareholders equity to derive this value for both 2024 and 2023, and we find that total assets is equal to total liabilities and shareholders equity for both 2024 and 2023 of December end. So this balances the balance sheet. Now we're on the Microsoft Investor Relations page. Now I'm going to show you the earnings and financials, and by going to the balance sheet, how it balances the balance sheet. So this is the earnings release for fiscal year 2025 quarter 3. So if we talk about March 31st 2025, the assets, the total assets is, and it should be in millions of dollars, so it is 562,624 millions of dollars, and that equals to 562,624 millions of dollars of total liabilities and stockholders equity. That means shareholders equity. So the balance sheet balances out for March 31st 2025, and similarly for June 30 2024 the total assets is 512,163 millions of dollars. That equates 512,163 millions of dollars of total liabilities and stockholders' equity. So congratulations, Microsoft's balance sheet balances out.